Hello everyone, let us continue with our discussion. Okay, so till now we have a good understanding about the financial statements and how to read it and what are the different components and the aspects of it. Okay, so now we are entering into the two new points. Number one is audit, and the second one is your audit report. Audit report. Clear? Now, in first phase which you have discussed, all the information was given by the company management, by the company's management. Clear? But audit is done by someone outside the organization, it's like a second opinion. Okay, just like you ask a doctor to double check your medical report. Clear? So in the same way, company prepare their financial statements like profit and loss, balance sheet, cash flows, but before it went public, okay, or it went to the investors who are going to trust these numbers, we need a qualified outsider to verify if these numbers are true and fair. See the words true and fair. See, no one can give your 100% accuracy report that this is 100% accurate. That's why they are using the word true and fair. Clear? And for that we need a qualified outsider. Qualified means someone who has the knowledge of how to qualify a given report. Clear? So that particular outsider who is qualified, clear, we call them as an auditor. Clear? And they are generally from a professional accounting firms. Clear? So imagine a student tells the teacher that they got 85 marks in maths. Clear? Would the teacher believe them or not? The answer is no. The teacher definitely want to see the report card. Now imagine the parents want to double check whether the marks on the report card are correct or not. So what they will do, they will ask the school office to verify the official records. This is known as an audit. Clear? So right now audit is a review of financial statements, a review of financial statements, a review of financial statements, a review of financial statements by someone independent, So actually, who actually conduct this audit? Who is actually conduct this audit? So for to conduct this audit, we need the chartered accountants. In India, we call them as a chartered accountants. Okay, in US, they are known as a CPA, chartered public accountants, and they are hired by the companies, that is the board of directors, to do the audit. Clear? Who hire them? The board of director of the company. See, this is a company A. Clear? And they are the board of directors of this company. He is a board of director of the company. So now he will visit some CA firm, and there are many CAs. So this board of director will say that you will audit my company. So from this company, few CA will go to the company. They will check all the documents, all the PL, balance sheets, invoice, ledger, each and everything will be checked and verified by them. Clear? So their job is to examine the company's accounting systems, internal controls, assets and liabilities, and all the supporting records. Write down what they are going to check: company's accounting system, company's accounting system, internal controls, asset and liability, and supporting all the records. Supporting all records means if they are saying that they made a sales of say 1800 crores, so they will check all the invoice, and after checking everything, they will give the opinion. After checking all these records, they will give the opinion. Clear? about whether the financial statements are correct, about whether the financial statements are correct and follow the accounting rules, and follow the accounting rules, and follow the accounting rules like IFRS or US GAAP, like IFRS or US GAAP. Now the question is, what are internal controls? What are internal controls? What are internal controls? So basically there are companies own systems. Write down these are the company's own systems. These are the company's own systems to prevent error, to prevent errors and fraud, to prevent errors and fraud, to prevent errors and fraud, and make sure accurate records are kept, and make sure accurate records are kept. See, requiring, basically this require the people to sign a check, okay, or keeping the digital logs of all the transaction. So in US, particularly in US, for all the public companies, the auditor must give an opinion on the quality of internal control as well. Means they not only check the financial statement, they will also check how the internal control is, means how well a particular company is ensuring that there is no possibility of frauds inside the organization. Clear? Now once the auditor will check everything, they will create a report. They will create a report, and we call that as a auditor's report. Now this auditor report is included in the annual report. Clear? There is an annual report which includes your financial statements like profit and loss, balance sheet, cash flow, then all the discussions, okay, M&A, everything is there, footnotes, clear, segmentations, every information is there, and at the end you will find a auditor's report. You will find a auditor's report. See, auditor's report is included in your annual report, and it tells us that whether the financial statements are, write down, it tells us whether the financial statements are free from material error, free from material error. That means there is no such specific errors. Clear? Second, it is in line with accounting standards, means they are following the accounting standards, means they are following the accounting standards. Third is based on reasonable estimates, based on reasonable estimates and judgments, based on reasonable estimates and judgments. Clear? Now write down the next point. Write down the next point. Three key parts of standard audit opinion. Three key parts of standard audit opinion. Now, number one, responsibility. See, the financial statements were prepared by the management, not the auditor. So it's the job of the auditor to independently review them. Clear? So financial statements are prepared by the company, and then it is audited, or you can say independently reviewed by the auditor. So that's his job, that's his responsibility. Clear? Now coming to point number B, standards. See, the auditor actually followed some generally accepted accounting standards. Okay, means there is a method, there is a given framework which they have to follow. Clear? And which actually give the reasonable assurance that the statement are correct. See the word they are using, reasonable assurance, means there is no 100% guarantee, but reasonable assurance that statements are correct. Clear? So they have a They have a defined standards. Clear? They have a defined standards. Now, coming to the point number C, that is your opinion. Point number C, that is the opinion. See, the auditor believes the financial statements are in line with the accounting rules and based on the reasonable estimates and prepared consistently across the period. When I say consistently across the period means 2, 3, 4, 5 years down the line. 2, 3, 4, 5 years down the line. So first, responsibility. Second, they follow the generally accepted auditing standard, means how you will do an audit. For that also there is a dedicated procedure. Clear? And the third one is the opinion. Third one is the opinion. Basically, the auditor believes that the financial statements are in line with the accounting rules based on the reasonable estimates, and third, they are prepared consistently across the periods. Clear? Now, I'll be discussing this audit opinions. Okay. Now there are three different types, or you can say four, rather than if I'll say more detail, four different types of audit opinions. Audit opinions are of four types. Audit opinion means in their report what they will write, whether the report is accurate, not accurate, fully accurate, something missing, how they will mention it. So the first one is unqualified opinion. Unqualified opinion. This is the first one, and this is what every company wants. What it actually says, we the auditor believe the financial statements are true and fair and they follow all the accounting rules, and this is what every company wants. It shows the true and fair view of the financial statements. Now second comes the qualified. Qualified. Over here the auditor says that most of the things are fine, but there are some issues or exception you should know. Clear? Few of the things are some, means there are some issues. So when I say qualified, that means there are some issues. Matlab, this means that most of the things are fine. Most of the things are fine and they are aligned with the rules and regulations. Now the third one which we have is the adverse opinion. Adverse opinion. See the word adverse means this is serious. The auditor says that the financial statements are not reliable and do not follow the accounting standards. Write down. This is serious. And auditor says this is serious, and auditor says the financial statements are not reliable. Underline this word, not reliable, and do not follow, underline this term, do not follow accounting standards. Write down the fourth one, disclaimer of opinion. See, over here the auditor says that we could not complete the audit, so we can't give our opinion. That means there is something which is missing, some information is missing which company have denied that they will not provide, and hence they could not complete the audit, so they cannot give the opinion. That's why they say disclaimer of opinion. We cannot give our opinions. Clear? Now there is one more term which have been used, is a modified opinion. Write down modified opinion. Write down any opinion that is not unqualified. Write down the term not unqualified. So can you say qualified? Means writing the same thing but in a different manner is known as a modified opinion. Clear? So that includes each of the three, that is your qualified, adverse, as well as disclaimer. Clear? So if someone is writing that there is a modified opinion, clear, that means it can include any of the three. Clear? Now there is one more point, is about the going concern. Means if auditor believe that there is a possibility that this business will not go ahead, say after 2 years, 3 years, or even 5 years, after that period this business will close. That means there is no going ahead for the given business. Clear? That's the point of going ahead assumption. Okay. So basically this is the idea that the company will continue to operate in the near future, but if auditor have the doubt about this, that they will go bankrupt in the near future, so they will mention that in their report. Clear? Then before I end this lecture, there are 2 points, KAMS and CAMS. KAMS means key auditor matters. Key auditors matters. Clear? And CMS means critical audit matters. Critical audit matters. Critical audit matters. So basically these are the special topics that the auditor think they are very important for the users of the financial report to understand. Now the point is what they actually include, why the auditor think that this is important. So this includes, number one, write down complex accounting choices. Complex accounting choices. Complex accounting choices. Second, transaction that were hard to verify. Transaction that were hard to verify. Transactions that were hard to verify. And third, areas where the management made big estimates or guesses. Areas where management have made big estimates or guess. Clear? That this will happen, that will happen, like that. Clear? So suppose if a company is involved in a major lawsuit, okay, or valued their brand has 1000 crores, but auditor might explain how they have verified that whether in reality their brand value 1000 crores or no. Clear? So I'll keep this lecture only with respect to the audit, and in next lecture I'll take the discussion ahead. Thank you.